Chapter 1: Introduction to the World of Futures. To understand the modern financial landscape, one must first look beyond the immediate exchange of goods for cash. While the average person interacts daily with the spot market, paying for a gallon of gasoline or a bag of groceries at the current advertised price, the global economy breathes through the lungs of the futures market. This is a realm not defined by what is happening right now, but by a collective, calculated consensus of what will happen months or even years down the line. It is the sophisticated extension of an ancient human impulse, the desire to lock in certainty in an inherently uncertain world. The evolution of these markets is a journey from the muddy riverbanks of medieval trade fairs to the lightning-fast fiber optic networks of today's electronic exchanges. Originally conceived as a tool for Japanese rice merchants and Midwestern grain farmers to hedge against the unpredictability of the seasons, futures have transformed into a multi-trillion-dollar ecosystem. What began as a physical necessity, ensuring a farmer could sell his harvest at a fair price before it even left the ground, has become the primary mechanism for price discovery across every asset class imaginable, from crude oil and gold to interest rates and digital currencies. At its core, a futures contract is a binding commitment to buy or sell an asset at a predetermined price at a specific point in the future. This simple structure serves as the bedrock of global price discovery, providing a transparent window into where the world believes the value of a commodity is headed. Unlike the spot market, which reflects the immediate pressures of supply and demand, the futures market aggregates the expectations, fears, and strategies of millions of participants. It is a massive, real-time weighing machine for global sentiment, allowing businesses to plan for the future and investors to capitalize on the shifting tides of the global economy. In the chapters that follow, we will dismantle the complexity of these instruments to reveal the elegant blueprint beneath. Understanding futures is not merely about learning a new way to trade. It is about gaining a vantage point that allows you to see the mechanisms of global finance with total clarity. Whether you are seeking to manage risk in a volatile portfolio or aiming to profit from macroeconomic trends, the futures market offers a level of leverage and liquidity that is unmatched in any other arena. This is where the price of tomorrow is decided today. Chapter 2: Contract Specifications and Market Structure. To navigate the futures market without understanding contract specifications is like attempting to pilot a plane without knowing the layout of the cockpit. At its core, a futures contract is not a vague agreement or a handshake deal. It is a legally binding, highly standardized instrument that dictates every nuance of the transaction. Unlike the fragmented world of OTC, over-the-counter trading, where terms can be negotiated in the shadows, the futures market thrives on absolute uniformity. Whether you are trading crude oil, treasury bonds, or lean hogs, the contract specifies exactly what is being traded, how much of it is in a single unit, and the precise moment the obligation reaches its finish line. The DNA of a contract is found in its specifications, or specs. These define the underlying asset, the physical commodity or financial instrument that gives the contract its value, and the contract's size, which acts as the multiplier for your profit or loss. For instance, a standard gold futures contract represents 100 troy ounces. A $1 move in the price of gold is not just a dollar in your account, but a $100 swing in the value of your position. Understanding these increments, or ticks, is the first step in risk management. Without this clarity, a trader is essentially blindfolded, unaware of the actual financial weight they are moving across the board. Beyond the mathematics of the contract lies the structural fortress that makes this entire ecosystem possible: the exchange and the clearinghouse. In the wild west of finance, counterparty risk, the fear that the person on the other side of your trade won't pay up, is a constant shadow. The futures market eliminates this through a centralized clearing model. When you buy a contract, the clearinghouse effectively becomes the seller to every buyer and the buyer to every seller. It acts as the ultimate guarantor, ensuring that even in periods of extreme volatility, the integrity of the trade remains intact. This structure is governed by rigorous regulatory bodies, such as the CFTC in the United States, which oversee the marketplace to prevent manipulation and ensure that the blueprint is followed by every participant. Finally, one must master the temporal nature of these instruments, the expiration cycle. Unlike a share of stock that you can theoretically hold until the end of time, a futures contract is a decaying asset with a hard deadline. As the expiration date approaches, the contract must either be settled physically, where you take delivery of the actual asset, or, more commonly for traders, settled in cash or rolled forward into a new month. This mechanical cycle creates a unique rhythm in the market, dictating liquidity flows and price behavior. Mastering this structure is not merely an academic exercise. It is the fundamental prerequisite for ensuring that your strategy survives the transition from theory to the live floor. Chapter 3. Leverage and margin requirements. In the world of traditional investing, we are taught to think in terms of possession. To own a share of a company, one must typically pay its full market price. In the futures market, however, we shift our perspective from ownership to obligation. Leverage is the architectural cornerstone of this landscape, acting as a high-powered lens that magnifies both the potential for profit and the gravity of risk. It is the mechanism that allows a trader to control a significant amount of a commodity or financial instrument with only a fraction of the total value held in equity. While this power is what draws many to the arena, it is a double-edged sword that requires a disciplined hand to wield. To understand leverage, one must first master the mechanics of the margin. Unlike a down payment on a house or the margin used in stock trading, which is essentially a loan from a broker, futures margin serves as a good faith deposit or performance bond. When you enter a contract, you are required to post an initial margin to ensure you can meet the financial obligations of the trade. This capital sits as collateral, a stabilizing force that guarantees the integrity of the marketplace. However, this is not a static figure. The mark-to-market process ensures that your account is adjusted in real time, reflecting the daily ebbs and flows of the market price. The true test of a trader's resilience often lies in the narrow gap between the initial margin and the maintenance margin. The maintenance margin is the minimum amount of equity that must remain in your account to keep a position open. Should the market move against you and your balance dip below this threshold, the dreaded margin call arrives, requiring an immediate infusion of capital to bring the account back to the initial level. This cycle of valuation is the pulse of the exchange, a relentless accounting that ensures every participant is solvent and every promise is backed by liquid value. Mastering these concepts is less about memorizing formulas and more about respecting the scale of the forces at play. When you control 100 ounces of gold or thousands of barrels of oil with a small deposit, you are navigating a landscape where small market fluctuations can lead to outsized outcomes. By demystifying the relationship between borrowed power and required collateral, you transition from a spectator to a strategist, capable of leveraging the market's volatility without being consumed by its weight. Chapter 4. The ecosystem. Who trades futures and why? To the untrained eye, the blinking red and green digits on a trading terminal represent a chaotic storm of random movements. But beneath the surface of every price tick lies a sophisticated biological system, a financial ecosystem as diverse and interconnected as a rainforest. In the futures market, no single participant exists in isolation. Every trade is a handshake between two parties with fundamentally different goals, risk tolerances, and time horizons. Understanding the who behind the trade is not just a matter of curiosity, it is the key to deciphering why the market moves the way it does. At the heart of this ecosystem are the hedgers, the pragmatic anchors of the market. These are the farmers, commercial airlines, and multinational corporations who use futures not to gamble, but to find certainty in an uncertain world. For a corn producer in the Midwest or a jewelry manufacturer in Milan, the futures market is an insurance policy. They aren't looking to beat the market. They are looking to lock in prices today to protect against the volatility of tomorrow. By offloading their price risk onto others, they provide the fundamental substance that makes the market necessary for the real-world economy. Opposing the hedgers are the speculators, the liquidity providers who are willing to embrace the very risk that others seek to avoid. Whether it is a solo retail trader in a home office or a gargantuan hedge fund in Greenwich, speculators are the hunters of the ecosystem. They provide the essential service of liquidity, ensuring that when a hedger needs to sell, there is always someone ready to buy. Without the speculators' appetite for profit and their willingness to assume calculated risks, the gears of the marketplace would grind to a halt, leaving prices static and participants stranded. Operating in the shadows between these two groups are the arbitrageurs, the market mechanics, who ensure efficiency. These participants look for fleeting discrepancies, tiny price gaps between gold in New York and gold in London, or between a futures contract and its underlying cash asset. Like professional scavengers, they snap up mispriced opportunities, and in doing so, they knit the various global markets together into a cohesive whole. Though their margins are razor thin, their presence ensures that the blueprint of the market remains balanced, fair, and functional for everyone involved. Chapter 5: Tick Sizes, Values, and Profit Calculation. To the uninitiated, the flashing green and red numbers on a trading terminal can feel like a chaotic blur, a digital ocean of noise with no discernible rhythm. However, for the professional futures trader, these numbers represent a precise and rigid geometry. Every instrument possesses its own DNA, a specific set of rules that dictate how it breathes and moves. Understanding this architecture is not merely a technical requirement. It is the bridge between reckless gambling and calculated risk management. Before you can master the psychology of the market or the nuances of strategy, you must first master the mathematics of the tick. In the world of futures, price does not move in a continuous, fluid stream. It moves in discrete, incremental steps called ticks. A tick is the smallest allowable price fluctuation for a specific contract, and its value is the foundational unit of your financial reality. Whether you are trading E-mini S&P 500 futures, where a single tick represents 0.25 index points, or crude oil, where it moves in 0.1 increments, these measurements define the pulse of the asset. Failing to internalize these increments is like trying to build a skyscraper without knowing the difference between an inch and a mile. Without this precision, your profit targets and stop-loss orders are nothing more than guesswork. The leap from understanding a tick to calculating profit and loss is where the abstract becomes concrete. In futures trading, we use point value to translate market movement into actual currency. For instance, in the S&P 500 E-mini, a full point consists of 4 ticks, and each point is worth $50 per contract. If the market moves 5 points in your favor, you aren't just seeing a number change on a screen. You are experiencing a $250 shift in equity per contract. Mastering this mental shorthand allows you to strip away the emotional weight of the dollar signs and focus on the mechanics of the trade. You stop seeing money and start seeing mathematical units of risk and reward. Ultimately, your success as a trader depends on your ability to quantify your edge. This requires a granular understanding of how slippage, commissions, and tick values interact to form your net bottom line. If you do not know exactly how much a 10-tick move against you costs in real time, you cannot effectively size your positions or manage your capital. This chapter is designed to dismantle the complexity of these calculations, providing you with the foundational math required to navigate the futures markets with the cold, calculated precision of a professional. By the time you reach the final page of this section, the movement of the market will no longer be a mystery, it will be a solvable equation. Chapter 6: Selecting your market, indices, commodities, and more. Choosing your battlefield is as critical as the strategy you carry into it. In the vast landscape of the futures markets, not all terrains are created equal. A trader who thrives in the lightning-fast oscillations of the S&P 500 might find themselves adrift in the seasonal, supply-driven rhythms of soybean meal. To build a sustainable futures blueprint, you must align the inherent personality of a market with your own risk tolerance, capital constraints, and psychological makeup. The goal isn't simply to find a market that moves, but to find one whose movements make sense to your unique perspective. For most beginners, equity indices serve as the most logical entry point. Instruments like the E-mini S&P 500 or the NASDAQ 100 offer a familiar environment reflecting the collective health of the corporate world. These markets are prized for their exceptional liquidity, the ease with which you can enter and exit a position without significant price slippage. Because thousands of participants are trading these contracts every second, the bid-ask spread remains tight, ensuring that your execution is efficient. For the intraday trader, indices provide the constant volatility necessary to capture profits within a single session, though their speed requires a disciplined hand. Beyond the world of stocks lies the visceral realm of physical commodities: energy, metals, and agriculture. Trading crude oil or gold is a different beast entirely, often influenced by geopolitical tensions, weather patterns, and global supply chain disruptions. While indices generally track with investor sentiment, commodities follow the raw laws of supply and demand. If you find yourself fascinated by global macro trends, such as how a drought in Brazil affects coffee prices or how OPEC meetings ripple through the gas pump, these markets offer a tangible connection to the global economy. However, they can be prone to gaps and sudden spikes, making them better suited for those who have mastered the basics of risk management. Finally, the sophisticated corners of currencies and interest rates provide a playground for the macro strategist. The foreign exchange (FX) futures market allows traders to speculate on the relative strength of economies, such as the euro against the US dollar, while interest rate futures like the 10-year Treasury note offer a way to trade the shifting tides of central bank policy. These markets are often deeper and more trending than equities, but they require a keen eye on the news cycle. As you evaluate these categories, remember that your choice is not permanent, but it should be focused. Mastery in the futures world rarely comes from being a jack of all trades. It comes from becoming a specialist in the specific rhythms of your chosen instrument. Chapter 7: The Trader's Toolbox: Platforms and Data. In the world of high-stakes futures trading, your technical infrastructure is more than just a convenience. It is your command center. Before you place your first contract, you must recognize that your choice of broker and platform represents the foundation upon which your entire strategy will rest. Just as a master craftsman would never attempt to build a cathedral with dull, improvised tools, a professional trader cannot hope to navigate the volatile currents of the global markets using a subpar execution engine. Your setup must be a seamless extension of your intent, allowing for split-second decisions to be translated into action without friction or hesitation. Selecting a broker is the first critical decision in building this foundation. This is not merely about finding the lowest commissions, though cost efficiency is vital for long-term profitability. You are looking for a partner that offers robust risk management, deep liquidity access, and most importantly, financial stability. The ideal broker acts as a bridge to the exchange, providing a specialized environment where margin requirements are transparent and order routing is optimized for speed. In this stage, you are vetting the gatekeepers of the marketplace to ensure that when the opportunity for a futures blueprint trade arises, your entry into the arena is guaranteed and secure. Once the brokerage is established, the focus shifts to the trading platform, the cockpit from which you will direct your capital. A professional platform should offer a balance of sophisticated analytical power and intuitive design. Whether you require advanced depth of market DOM displays to read order flow or complex charting packages to identify macro trends, the software must be reliable under pressure. A platform that freezes during high volatility events is a liability that no trader can afford. Your goal is to customize this workspace so that every data point and execution button is positioned for maximum cognitive efficiency, reducing the lag between your brain's analysis and your fingers' click. Finally, the lifeblood of this entire system is the data feed. In the futures market, information is moving at the speed of light, and the quality of your data can be the difference between a precision entry and a costly error. Unfiltered, tick-by-tick data is the standard for anyone serious about the craft. You must understand the distinction between various data providers and how they integrate with your platform to ensure that what you see on your screen is a true, real-time reflection of the exchange's limit order book. By mastering these three pillars, broker, platform, and data, you transition from a spectator to a fully equipped participant, ready to execute your blueprint with professional-grade precision. Chapter 8. Price Dynamics, Contango, Backwardation, and Basis. To the uninitiated, the price of a futures contract might seem like a simple mirror reflection of the current market value. However, once you step onto the trading floor, you realize that time itself has a cost, a weight that pulls at the price of every contract. This relationship between the present spot price and the future delivery price is not static. It is a living, breathing landscape shaped by storage costs, interest rates, and the collective anxiety or optimism of the market. Understanding this landscape requires mastering the language of the curve, the steep climbs of contango and the downward slopes of backwardation. In a state of contango, the market is looking forward with a sense of abundance, or perhaps the burden of logistics. Here, the futures price is higher than the spot price, often reflecting the cost of carry, the cold hard expenses of warehousing grain, insuring gold, or financing oil shipments. When a market is in contango, the passage of time acts as a slow erosion. As the contract nears its expiration date, its premium must inevitably evaporate. This process, known as convergence, ensures that on the final day of the contract, the futures price and the spot price meet in a final mathematical embrace. Conversely, backwardation tells a story of urgency and scarcity. When the immediate need for a commodity outweighs the desire to hold it in the future, the spot price surges above the futures price. This inverted curve often signals a supply shock or a right-now demand that participants are willing to pay a premium to satisfy. For the trader, navigating backwardation is like running down a hill. The tailwinds of time can actually add value to a position as the cheaper futures price climbs to meet the higher spot price at maturity. At the heart of these fluctuations lies the basis, the simple but profound difference between the local cash price and the futures price. The basis is the pulse of the physical market, accounting for the unique frictions of geography and timing. While the broad market trends may grab the headlines, the seasoned professional watches the basis and the shape of the curve. They know that in the world of futures, you aren't just trading an asset, you are trading the invisible, shifting bridge between today's reality and tomorrow's expectations. Chapter 9. Technical Analysis. Part 1. Charting Foundations. To the uninitiated, a price chart looks like a chaotic electrocardiogram of global greed and fear, a jagged, incomprehensible pulse of red and green. Yet, for the disciplined trader, these lines and bars are not noise. They are a sophisticated visual language. Every tick of the market represents a localized battle between a buyer and a seller, and the chart is the map that records who is winning the war. To master the futures market, you must first learn to translate this visual data into actionable intelligence, moving beyond seeing mere shapes to understanding the underlying psychology they represent. The cornerstone of this visual language is the Japanese candlestick, a tool developed centuries ago by rice traders that remains the gold standard for clarity today. Unlike a simple line chart, which only tracks the closing price, a candlestick provides a four-dimensional view of a specific period: the open, the high, the low, and the close. The body of the candle tells you who dominated the session, while the wicks or shadows reveal the price levels that were rejected. When you look at a daily candle, you aren't just looking at a price range. You are looking at a story of conviction, exhaustion, and the push and pull of liquidity. Building upon these individual data points is the concept of market structure, the skeletal frame upon which all technical analysis is hung. Prices do not move in straight lines. They move in a series of peaks and valleys, known as swing highs and swing lows. By identifying whether the market is producing higher highs or lower lows, you begin to discern the primary trend. This is where the blueprint begins to take shape. Understanding structure allows you to zoom out from the frantic minute-by-minute fluctuations and recognize the broader patterns of accumulation and distribution that dictate where the next big move is likely to occur. As we lay these foundations, it is vital to remember that a chart is a reflection of human behavior, not a crystal ball. Technical analysis is the art of identifying high-probability repetitions in that behavior. By mastering the basic anatomy of charts, from the construction of a single bar to the rhythmic flow of market trends, you gain the ability to filter out the static. You stop guessing where the market might go and start observing what the market is actually doing. This clarity is the prerequisite for everything that follows in your trading journey. Chapter 10. Technical Analysis Part 2. Support, Resistance, and Trends. If trading is a visual language, then support and resistance levels are the punctuation marks that give the market story its structure. Without them, a price chart is merely a chaotic sequence of data points, a mountain range seen through a thick fog. To master the futures blueprint, you must learn to see the invisible floors and ceilings where the collective psychology of thousands of traders suddenly shifts. Support represents the floor, the point where demand becomes strong enough to overpower selling pressure, preventing the price from falling further. Resistance is the ceiling, the zone where sellers emerge in droves, capping the upward momentum. These aren't just lines on a screen, they are the scars of past battles between bulls and bears. Identifying these key areas of interest allows you to move away from reactive gambling and towards strategic anticipation. When you look at a chart, your goal is to locate the zones of high conviction. These are the historical price levels where the market has shown a repetitive memory. By drawing these zones, you are essentially mapping out the battlefield before the first shot is fired. However, the true skill lies in understanding that these levels are fluid rather than fixed. A broken resistance often flips to become new support, a phenomenon known as a role reversal that marks the beginning of a shift in market sentiment. Once you can identify these psychological barriers, you must layer in the concept of trend lines to determine the market's trajectory. A trend line is more than just a diagonal stripe. It is a visual representation of a market's health and speed. By connecting the higher lows in an uptrend or the lower highs in a downtrend, you can visualize the path of least resistance. This provides the necessary context to determine which phase the market is currently occupying. Whether the market is in a period of quiet accumulation, an explosive trend, or a volatile distribution phase, the trend line acts as your compass, ensuring you are never swimming against the broader tide of capital. Understanding these market phases, accumulation, trend, and distribution, is what separates the professional from the amateur. Accumulation is the silent phase where smart money builds positions while the public remains fearful. This is followed by the trend phase, where the direction becomes clear and momentum picks up. Finally, distribution occurs at the top of the cycle as informed traders sell their positions to latecomers who are buying into the hype. By mastering the intersection of horizontal support and resistance with the diagonal force of trend lines, you develop the ability to read the life cycle of a move before it fully unfolds. Chapter 11. Technical Analysis. Part 3. Using indicators effectively. To many newcomers, a trading screen layered with technical indicators looks like a cockpit of a fighter jet. Sophisticated, precise, and authoritative. There is a seductive comfort in the geometry of a Bollinger Band or the oscillating rhythm of the RSI. They offer a sense of mathematical certainty in a market defined by chaotic human emotion. However, the most successful traders treat these tools not as crystal balls, but as statistical filters. They are overlays designed to strip away the noise of price action, allowing the underlying trend to emerge with greater clarity. When we look at moving averages, we are essentially looking at the market's memory. By smoothing out the jagged spikes of daily volatility, these lines reveal the gravity of a trend. Whether you're tracking the fast-paced 50-day average or the institutional benchmark of the 200-day, these indicators serve as atmospheric sensors. They tell you whether you are flying with a tailwind or fighting a headwind. Yet, the trap lies in waiting for a crossover as a definitive command to buy or sell. In the futures blueprint philosophy, a moving average is a map of the terrain, not a GPS telling you exactly when to turn. Moving deeper into momentum and volatility, tools like the MACD and Relative Strength Index, RSI, serve as the market's speedometer. They help us identify when a move has become overextended, when the rubber band of price has been stretched so far that a snapback is statistically probable. Similarly, Bollinger Bands provide a visual representation of price standard deviation, expanding and contracting like a living lung. When the bands tighten, the market is holding its breath before a breakout. When they flare, the volatility is peaking. The secret to mastery is avoiding indicator soup. Many traders make the mistake of layering 5 or 6 different oscillators on a single chart, only to find themselves paralyzed by conflicting signals. This is known as analysis paralysis. Instead, the goal is to pick a small complementary suite of indicators that confirm different aspects of the market, one for trend, one for momentum, and one for volatility. Remember, price is the primary truth. Indicators are merely the adjectives we use to describe what that price is doing. If the chart says one thing and the indicator says another, always trust the tape. Chapter 12, Volume and Open Interest, the Future's Secret Sauce. In the world of equities, price and volume are the 2 pillars of analysis, but in the futures market, a third dimension emerges to complete the picture: open interest. If price represents the where and volume represents the how many, open interest tells us how much conviction is actually being held in the market. It is the secret sauce that separates a fleeting price spike from a sustained structural trend. Without understanding these metrics, a trader is essentially flying a plane with a broken fuel gauge. You might be moving at a high altitude, but you have no idea how much propellant is left to keep you there. Volume acts as the immediate heartbeat of the market, measuring the intensity of the struggle between buyers and sellers within a specific time frame. It is the raw energy behind a move. When price breaks out on high volume, it signals that the collective market participant has reached a consensus, putting their capital where their convictions are. However, volume alone is a momentary snapshot. To understand the longevity of a move, we must look to open interest, the total number of outstanding contracts that have not yet been settled. This metric represents the new money flowing into the arena, providing a window into the commitment of the players involved. The synergy between these 2 metrics provides a roadmap for trend confirmation. When price is rising and both volume and open interest are increasing, we are seeing a healthy, fueled advance. New buyers are aggressively entering the fray, and the trend is likely to persist. Conversely, if the price continues to climb while open interest begins to wane, we are witnessing a short covering rally. This is a deceptive move, where the price rise is fueled not by new bulls, but by panicked bears closing out their positions. Once those bears finish their frantic buying, the fuel source vanishes, and the market often collapses under its own weight. As we dive into the mechanics of these indicators, you must learn to view them as the fuel behind the price engine. Volume is the throttle, showing us the immediate burst of speed, while open interest is the size of the gas tank. By mastering the relationship between these 2, you stop gambling on price direction and start trading the underlying strength of the market structure itself. In this chapter, we will break down the 4 key scenarios where volume and open interest reveal the true intentions of the smart money before the rest of the herd catches on. Chapter 13, Fundamental Analysis and Economic Indicators. To the uninitiated, the flashing red and green tickers of the futures market look like a chaotic digital storm, driven by nothing more than the whims of high-frequency algorithms and speculative fervor. However, beneath the surface of every price fluctuation lies a foundation of hard data, the bedrock of fundamental analysis. While technical analysis focuses on the how of price movement, fundamental analysis demands to know the why. It is the study of supply and demand, the pulse of geopolitical stability, and the cold, hard reality of raw production. In the world of futures, you aren't just trading numbers. You are trading the future availability of the world's most essential resources. The lifeblood of a fundamental trader is the economic calendar, a chronological roadmap of high-impact events that serve as the primary catalysts for volatility. This isn't just the news in a general sense. It is a series of choreographed revelations from central banks and government agencies that can shift the global landscape in seconds. Whether it is a Federal Reserve announcement regarding interest rate hikes or a sudden shift in the Consumer Price Index, CPI, these data points represent the collective health of an economy. Learning to read these reports is like learning a second language, where a single word change in a policy statement can trigger a 1,000-tick move in the S&P 500 or the US dollar index. In the agricultural pits, the stakes are even more literal, as traders wait with bated breath for the latest USDA reports. A World Agricultural Supply and Demand estimates released yeast can transform a quiet Tuesday into a frenzy of limit up or limit down activity. In these moments, the futures market acts as a giant sorting machine for information, weighing the impact of droughts in the Midwest against the export demands of emerging markets. To master this chapter of the blueprint is to move beyond the screen and understand the complex machinery of global trade. You will learn to filter the noise of the nightly news and focus instead on the core indicators that dictate where price must eventually go, regardless of what the charts might suggest in the short term. Chapter 14: Market Profile and Auction Market Theory. In the relentless tick of the financial markets, price is merely the advertising mechanism, but time is the ultimate regulator. To understand the market, not as a series of chaotic candles, but as a living, breathing auction, we must shift our perspective from simple directional movement to the logic of market profile. This framework, rooted in auction market theory, teaches us that the market's primary purpose is to facilitate trade. It does this by moving price until it finds a level where both buyers and sellers are willing to transact in volume. When you stop asking, "Where is the price going?" and start asking, "Where is the market finding value?" the chaotic noise of the charts begins to resolve into a coherent structural map. At the heart of this map lies the bell curve, a distribution of data that reveals the secret psychology of the crowd. Within any given session, the market carves out a value area, the price range where 70% of the day's trading activity occurred. This is the fair price zone, where the auction has found equilibrium. Standing as the anchor of this zone is the point of control, POC, the single price level where the most time or volume was spent. Recognizing the POC is like finding the center of gravity. It represents the strongest consensus of value for that period. When price drifts away from this center without a fundamental spark, it is often stretched like a rubber band, creating high probability opportunities for it to snap back to its mean. Trading with a time at volume mindset allows you to distinguish between cheap prices and good value. A sharp drop in price might look like a buying opportunity on a standard bar chart, but through the lens of a volume profile, you can see if that drop was met with heavy participation or if it moved through a thin area with no support. By identifying high-volume nodes and low-volume zones, you gain the ability to predict where the auction will likely stall and where it will accelerate. You are no longer chasing shadows. You are identifying the footprints of institutional players and positioning yourself where the true weight of the market resides. Chapter 15: Building a Robust Trading Plan. A professional trading plan is not a set of suggestions. It is the constitution of your financial sovereignty. Most traders operate in a state of perpetual improvisation, reacting to the flickering candles of a chart with the hope that their intuition will outweigh the market's volatility. However, true mastery is born from the transition from discretionary impulses to systematic execution. By defining your rules before the first tick of the opening bell, you remove the heavy burden of decision-making during moments of high stress. In this framework, your plan becomes an automated script, allowing you to act as the unemotional executor of a proven edge, rather than a gambler chasing a feeling. The architecture of a robust plan begins with the surgical precision of your entry triggers. You must be able to define in a single sentence exactly what conditions must be met for you to risk a single dollar of your capital. This involves more than just a moving average crossover or a breakout pattern. It requires a confluence of factors that shift the odds in your favor. When the setup appears, the plan dictates that you engage without hesitation. Conversely, when the market is noisy and your criteria aren't met, the plan provides the ultimate discipline, the permission to do nothing. In the world of futures, the trades you decline are often just as profitable as the ones you take. Once a position is live, the focus shifts from entry to the dual pillars of exit strategy: the profit target and the stop loss. A plan without a predetermined exit is merely a hope, and hope is not a strategy. You must visualize the end of the trade before it even begins, setting objective price levels that honor your risk-to-reward ratios. This is where if-then scenarios become your greatest asset. By pre-calculating how you will react if the market stalls at resistance, or what you will do if a sudden news event spikes volatility, you eliminate the panic of the unknown. You aren't guessing what to do as the price moves against you. You are simply following the instructions you wrote when you were calm, rational, and objective. Ultimately, building this blueprint is about creating a bridge between your current habits and the professional standard required for long-term survival. Systematic thinking transforms the chaos of the markets into a structured data set. When you trade a plan, every outcome, win or loss, becomes a valuable piece of information rather than a blow to your ego. You stop asking, "What do I think the market will do?" and start asking, "Does this moment align with my process?" This chapter will break down each component of that process, ensuring that when you step into the arena, you are backed by a rigorous, repeatable, and resilient system. Chapter 16, Risk Management, Protecting Your Capital. The allure of leveraged markets is often framed through the lens of exponential growth, but the veteran trader knows that the true art lies in the management of the downside. In the high-stakes arena of the futures blueprint, your offensive strategy is only as good as your defensive wall. Survival is not a byproduct of luck. It is a calculated result of rigorous risk management. Without a defined protocol to protect your capital, you are not trading. You are merely gambling with an expiration date. Capital preservation is the heartbeat of longevity, ensuring that a single sequence of losses does not evolve into a terminal event for your portfolio. At the core of this defensive architecture is position sizing, the mechanical lever that dictates how much of your psychological and financial skin is in the game. Many novices mistake leverage for a license to swing big, but true professionals use it to fine-tune their exposure. By determining your risk per trade as a fixed percentage of your total equity, you decouple your emotions from the market's volatility. This mathematical discipline ensures that even a catastrophic loss is merely a bruise, not a broken bone, allowing you to stay in the game long enough for your edge to manifest. Equally vital is the strategic placement of stop losses, the thermal breakers of your trading system. A stop loss should never be an arbitrary number or a reflection of your fear. It must be a logical exit point based on the market's structure. It represents the price at which your initial thesis is proven wrong. By honoring these exits without hesitation, you prevent the small mistake from spiraling into a devastating drawdown. Managing drawdowns is perhaps the most difficult psychological hurdle, requiring the humility to scale back when the market is out of sync with your strategy. Ultimately, protecting your capital is about maintaining your mental equity just as much as your account balance. When you master the techniques of controlled participation, you eliminate the existential dread that paralyzes most market participants. This chapter serves as the blueprint for that fortress. By internalizing these rules of engagement, you shift your focus from "how much can I make?" to "how much can I afford to lose?" A shift in perspective that separates the temporary winners from the masters of the futures market. Chapter 17, Order Execution Strategies and Order Types. The transition from analysis to action is where the conceptual world of charting meets the cold reality of the marketplace. You can have the most sophisticated predictive model in the world, but if your execution is sloppy, your edge will bleed out through 1,000 tiny cuts. Order execution is more than just clicking a button. It is the tactical deployment of capital. In the high-velocity environment of futures trading, understanding the mechanics of how you enter and exit the arena is what separates the professional operator from the retail gambler. At the most basic level, your primary choice is between certainty of price or certainty of fill. A market order is a demand for immediacy. It tells the exchange that you want in right now, regardless of the cost. While this ensures you won't miss a fast-moving trend, it exposes you to the bid-ask spread and the hidden tax of slippage. Conversely, a limit order allows you to dictate the terms of the engagement. By setting a specific price, You refuse to pay a penny more or receive a penny less than your target. The risk, of course, is that the market may never reach your level, leaving you standing on the sidelines as the move unfolds without you. To master the futures market, however, you must move beyond these binary choices and embrace conditional logic. The stop order is your primary tool for defense, acting as a structural floor or ceiling that triggers only when the market moves against you. But the real elegance in execution comes with the OCO, one cancels other, order. This setup allows you to bracket your trade with both a profit target and a stop loss simultaneously. Once one side is hit, the other vanishes, automating your discipline and removing the emotional burden of manual intervention during the heat of a price swing. Strategic execution is about minimizing friction. In thin markets or during high volatility news events, the gap between your intended price and your actual fill can be the difference between a profitable month and a losing one. By matching the right order type to the specific market condition, using limits in consolidation and stops for breakouts, you transform the order entry process from a moment of anxiety into a calculated mechanical step in your broader blueprint. Chapter 18: The Psychology of Trading, Developing Discipline. The siren song of the market is rarely a rational one. It is a primal chorus of fear and greed that resonates deep within the amygdala. To the uninitiated, the flashing green and red of a trading terminal represent more than just price fluctuations. They represent a direct assault on the ego. When the numbers climb, we are seduced by the illusion of genius, tempted to over-leverage in a desperate bid for more. When the screen turns red, a visceral panic sets in, a fight-or-flight response that compels us to freeze like a deer in headlights or to exit a sound position at the exact moment the tide is about to turn. Developing the mental fortitude of a professional trader begins with the uncomfortable realization that your greatest adversary is not the market or the algorithm, but the hardwired survival instincts that have served humanity for millennia but are catastrophic in the world of finance. True discipline is not the absence of emotion, but the ability to operate effectively while experiencing it. The professional trader views a profit and loss (P&L) statement not as a reflection of their self-worth or a tally of future luxuries, but as a neutral data point in a much larger sequence of events. To reach this state of emotional detachment, you must consciously decouple your identity from the outcome of any single trade. Professionalism is measured by how strictly you adhere to your process, regardless of whether the market rewards you in the short term. It is the quiet, sustained patience to wait for the setup that meets every one of your criteria, and the cold-blooded resolve to cut a loss the moment the thesis is invalidated. To bridge the gap between reactive impulse and disciplined execution, you must treat your mental state as a technical variable. Practical exercises, such as keeping a psychological trade journal, can reveal the hidden patterns of your behavior. By recording not just the entry price, but the physical sensations and thoughts you felt as the trade developed, you begin to see the fear and greed cycle for what it is, a predictable, manageable phenomenon. Over time, through deliberate practice and rigorous self-analysis, the chaos of the market begins to feel like a controlled environment. You stop trading the P&L and start trading the plan, transforming the volatile energy of your emotions into the steady discipline that defines the elite. Chapter 19: Core Trading Strategies, Breakouts and Reversals. To master the markets is not to predict the future with a crystal ball, but to recognize the recurring fingerprints of human psychology etched onto a price chart. High-probability patterns are essentially visual representations of a shift in the balance of power between buyers and sellers. When we talk about core trading strategies, we are identifying specific moments where the tension of the market has reached a breaking point. Whether it is a coil ready to spring or a pendulum reaching its furthest arc, these setups provide the framework for consistent execution, turning the chaotic noise of price action into a structured, repeatable plan. The breakout strategy is the quintessential play for capturing momentum. It occurs when price breaches a clearly defined level of horizontal resistance or support that has held firm over multiple tests. Think of a breakout as a physical barrier, finally giving way under immense pressure. Once the dam breaks, The resulting rush of volume and volatility can be explosive. To validate a high-probability breakout, you must look for the squeeze, a period of tightening consolidation just beneath the level, accompanied by a surge in volume that confirms institutional participation. Without that surge, you are merely witnessing a head fake. With it, you are riding the crest of a new directional wave. On the opposite end of the tactical spectrum lies mean reversion, often referred to as the rubber band trade. This strategy is predicated on the mathematical reality that price eventually returns to its average. When a market becomes overextended, stretched too far and too fast away from its moving averages, it enters a state of exhaustion. The goal here isn't to fight the trend, but to identify the specific exhaustion candles or divergence in momentum oscillators that signal the snap back. It requires a contrarian mindset and a disciplined approach to risk, as you are essentially betting that the current enthusiasm or panic has reached its limit and a correction is imminent. Success in these setups rests entirely on the rigor of your entry criteria, which is why every trader must operate from a fixed setup checklist. A high probability pattern is not a vibe or a gut feeling. It is a confluence of factors that align to tip the odds in your favor. Before placing a single contract, you must ask, is there a clear catalyst? Does the volume confirm the move? Is the risk to reward ratio at least 2-to-1? By stripping away the emotional impulse to just get in and replacing it with a binary set of requirements, you transform trading from a gamble into a professional operation of statistical edge. Chapter 20: Institutional Insights, Seasonality and Cycles. To the casual observer, the movement of global markets can appear as chaotic as a sudden summer storm, unpredictable, jagged, and driven by the whims of the moment. However, beneath the surface of the daily price action lies a rhythmic heartbeat dictated by the inexorable changing of the seasons. In the world of commodities, geography and the calendar are destiny. Whether it is the planting cycles of the American Corn Belt or the surging demand for heating oil as the Siberian high-pressure system descends, these physical realities create recurring patterns that repeat with uncanny statistical regularity. Seasonality is not a crystal ball, but it is one of the most powerful directional tailwinds available to the institutional trader. While an individual news event can cause a temporary spike, the fundamental laws of supply and demand are often tied to the Earth's orbit. For example, the driving season in the United States exerts a predictable upward pressure on gasoline futures as families take to the roads in June and July, just as natural gas prices often bottom out in the shoulder months before the winter freeze settles in. By understanding these structural cycles, you move from guessing where the price might go to knowing where the weight of historical probability is pushing it. Leveraging these cycles requires a shift in mindset from reactive trading to proactive positioning. Institutional investors look for confluence, the moment when a technical breakout aligns with a historical seasonal trend. If you are eyeing a long position in heating oil, doing so in late summer when inventories are being built for the winter provides a statistical edge that a random entry simply cannot match. It is about understanding the why behind the move, the harvest pressure that weighs on grain prices in the fall, or the pre-Lunar New Year demand that often bolsters the metals complex. In this chapter, we will deconstruct the specific cycles governing energy and agriculture, stripping away the market noise to reveal the underlying seasonal architecture. We will explore how to use historical percent profitable metrics to time your entries and exits, and more importantly, how to identify when a cycle is being disrupted by external shocks. Mastering seasonality means learning to trade in harmony with the natural flow of global commerce, ensuring that when you step into a position, the vast inertia of the calendar is working for you, rather than against you. Chapter 21: Hedging Strategies for Diversified Portfolios Base. In the popular imagination, the futures market is often portrayed as a high-octane casino, a place where speculators chase volatility and fortunes are made or lost on the tick of a decimal point. However, this perception ignores the bedrock upon which these markets were built. At its core, the futures contract was never intended as a gambling chip. It was designed as an insurance policy. For the wheat farmer facing an uncertain harvest, or the fund manager staring down a systemic market correction, the futures market serves as a vital sanctuary. It is the architectural foundation of risk management, allowing us to lock in prices and insulate our hard-won gains from the whims of a fickle economy. To understand hedging is to understand the art of the offset. When you hold a diversified portfolio of equities, you are essentially long the future of the economy. But when the winds shift and the technical indicators begin to sour, selling your entire portfolio is often impractical, triggering tax liabilities and disrupting your long-term compounding. This is where the short futures position enters the frame. By selling a futures contract against your existing holdings, you create a mathematical counterweight. If the market dips, the profit on your short futures position acts as a buffer, neutralizing the losses in your cash portfolio. You are no longer at the mercy of the trend. You are the architect of your own stability. This strategic application is often referred to as the synthetic protective put. While an options trader might buy a put option to floor their risk, a futures trader can achieve a similar defensive posture with greater capital efficiency and no time decay eating away at the position. By calculating your portfolio's beta, its sensitivity to the broader market, you can determine exactly how many contracts are needed to achieve a delta-neutral state. In this scenario, you aren't just guessing which way the wind will blow. You are building a fortress that remains standing regardless of the storm's direction. Hedging is not about avoiding the market. It is about staying in the game on your own terms. Chapter 22, The Trading Journal. Turning data into progress. In the arena of high-stakes trading, memory is a deceitful ally. We tend to remember our windfall profits with cinematic clarity while subconsciously sanitizing the reckless entries and emotional lapses that lead to our losses. Without a rigorous, objective record of your actions, you aren't actually running a business. You are merely participating in a high-speed guessing game. A professional trading journal is the bridge between gambling and mastery, serving as a cold, hard mirror that reflects not who you think you are as a trader, but who you actually are in the heat of the moment. To harness the power of your own data, you must move beyond simply recording prices and tickers. A true futures blueprint journal captures the anatomy of a trade, the technical rationale, the psychological state at entry, and the management of the position as it unfolded. By documenting the why behind every click, you transform a chaotic series of market events into a structured database of human behavior. Over time, patterns emerge from the noise. You begin to see the difference between a high-probability setup that simply didn't work and a low-probability impulse trade that happened to result in a lucky profit. The real transformation begins during the weekend review, when you shift from the role of the active performer to that of the dispassionate analyst. By examining key metrics like win rate, profit factor, and average risk-to-reward ratio, you can perform a surgical audit of your performance. If your profit factor is dragging despite a high win rate, your data might reveal a leaky bucket, a tendency to cut winners short while letting losers run. These statistics are not just numbers. They are diagnostic tools that pinpoint exactly where your capital is hemorrhaging and where your greatest mechanical edges lie. Ultimately, turning data into progress means making the leap from intuition to evidence-based execution. When you can look at a spreadsheet and see that your performance suffers every Tuesday morning, or that you consistently lose money on breakout plays, you gain the power to strike those behaviors from your playbook. This process of iterative refinement is what separates the perennial break-even trader from the elite professional. You don't get better by trading more. You get better by analyzing what you've already done and having the courage to fix the leaks the data exposes. Chapter 23, Introduction to Algorithmic and Automated Trading. In the traditional theater of finance, the image of the trader has long been one of high-octane emotion. Sweaty palms, frantic phone calls, and the gut-wrenching adrenaline of a split-second decision. However, the modern marketplace has largely traded these visceral human reactions for the cold, silent precision of silicon. Algorithmic trading, once the exclusive playground of high-frequency hedge funds and elite institutional desks, has democratized. We have entered an era where the bot is no longer a futuristic concept, but a primary participant, executing complex strategies with a level of speed and discipline that no human mind can replicate. To understand the futures landscape today, one must first understand the machines that now define its rhythm. At its core, an automated trading system, ATS, is the translation of a subjective trading philosophy into an objective set of mathematical rules. It is the process of taking your if-then scenarios, the technical indicators, price action patterns, and risk management parameters you've honed through experience, and codifying them into a language that the market's digital infrastructure can understand. When you turn on the bot, you are essentially delegating the burden of execution to a program that does not get tired, does not feel fear after a losing streak, and does not experience the dangerous euphoria of a winning one. It is the ultimate exercise in removing the human element from the transaction, ensuring that every entry and exit is handled with surgical consistency. Yet this transition from manual intuition to automated execution is not a panacea. It is a shift in the nature of the work. While automation mitigates the risk of emotional fatigue, it introduces the risk of systemic failure and black box complexity. A rogue algorithm or a poorly backtested script can liquidate an account faster than any human error ever could. The true art of the modern trader lies in the oversight, knowing when the market conditions have shifted so fundamentally that the logic of the code no longer applies. As we pull back the curtain on the automation landscape, we must view the bot not as a magic money-making machine, but as a high-performance engine that requires a skilled pilot to steer, monitor, and occasionally know when to shut down. Chapter 24, The Path to Full-Time Trading, Expectations versus Reality. The siren song of full-time trading is often composed of curated Instagram feeds, laptop screens on sun-drenched balconies, exotic sports cars, and the promise of financial freedom achieved in just 20 minutes a day. This glossy imagery is the primary currency of the modern-day snake oil salesman. These peddlers of effortless wealth sell a dream that bypasses the grueling mechanics of the market, offering secret indicators or guaranteed signals for a subscription fee. The first hurdle on your path to professionalism is developing a refined filter for this noise. If a strategy sounds like a shortcut, it is almost certainly a dead end. In the world of futures, alpha is earned through rigorous analysis and emotional discipline, not purchased via a 3-payment plan for a masterclass. The reality of professional trading is far less cinematic than the marketing suggests. It is not an adrenaline-fueled dash toward a jackpot. It is a meticulous, often repetitive process of risk management and data interpretation. Transitioning to full-time status means your lifestyle is no longer funded by a predictable salary, but by your ability to remain objective in the face of uncertainty. For the professional, a winning day isn't a reason to celebrate with a shopping spree, and a losing day isn't a crisis of identity. It is simply another data point in a long-term equity curve. Understanding this shift in temperament is the difference between those who treat the market as a casino and those who treat it as a business. Expect to spend months, if not years, in the valley of disappointment. The learning curve for futures trading is famously steep, characterized by a paradox. The more you try to force the market to give you a profit, the more it tends to take away. Many aspiring traders quit just as they are beginning to develop the necessary intuition because their expectations were calibrated for a sprint rather than a marathon. You must prepare for the psychological toll of the drawdown, the periods where your strategy is out of sync with the market and your bank account shrinks despite your best efforts. This isn't a sign of failure, it is the price of admission. Ultimately, the path is paved with spreadsheets and trade journals rather than gold. Success in this field requires a radical level of self-honesty and an almost monastic dedication to your process. You are moving from a world of, if I work X hours, I get Y pay, to a world where you can work 12 hours a day and end up losing money. Navigating this reality requires a blueprint that prioritizes capital preservation over quick gains. By stripping away the illusions of the get-rich-quick industry, you can finally begin the sober, rewarding work of becoming a professional participant in the global markets. Chapter 25, Conclusion, Your Blueprint for Market Mastery. The transition from learning a system to embodying a strategy is where the professional trader is born. Throughout this journey, we have dissected the mechanics of the futures markets, from the granular precision of order flow to the sweeping narratives of macroeconomic cycles. However, the blueprint is not a static document to be framed on a wall. It is a living manual that demands constant revision. Market mastery is not a destination characterized by a lack of mistakes, but a state of perpetual refinement. As you move forward, your greatest edge will not be a specific indicator or a proprietary algorithm, but your capacity for disciplined adaptation. The regimes that yielded profits yesterday may become the headwinds of tomorrow, and your survival depends on your ability to recognize these shifts before the crowd does. Scaling your operation is the next logical horizon, yet it is often where most traders encounter their steepest psychological hurdles. Moving from a few micro-contracts to a full-sized book requires more than just a larger account balance. It requires an expansion of your emotional capacity for risk. Your roadmap for the next 12 months should prioritize consistency over windfall gains. Focus first on the flawless execution of your edge, then on the gradual integration of size as your equity curve validates your discipline. Education does not end with the final page of this book. It merely shifts from the theoretical to the experiential. Every trading session is a new data point in your development, and every drawdown is a tuition payment in the school of market dynamics. As you embark on this next phase, view the market as a mirror, reflecting your internal state back to you. The technical setups are the easy part. The mastery of self is the lifelong pursuit. In the months ahead, commit to a rigorous routine of post-trade analysis, maintaining a feedback loop that identifies your strengths and ruthlessly exposes your weaknesses. The road to market mastery is paved with the compounding of small, correct decisions made over long periods of time. You now possess the tools, the framework, and the philosophy required to navigate the futures landscape. The blueprint is in your hands. The construction of your career begins with the very next trade.